Slide 1. Mapletree Industrial Trustees DPU just fell. Mapletree Industrial Trustees DPU just fell by 4.9%, and that headline number is not the real story. Three separate Hardgates, gearing, occupancy, and interest coverage, failed in the very same quarter. We are breaking down what actually happened underneath the surface. I'm Iggy. I run the numbers on SGX stocks so retirees don't have to guess. I'll be honest, my first read on this quarter's DPU cut was that it wasn't a big deal. Then I looked at gearing, occupancy, and coverage together and realized the dividend was the least of MIT's problems this quarter. The headline isn't the problem here. That 4.9% distribution drop is genuinely the smallest issue on the page. Aggregate leverage crossed straight through our ceiling, portfolio occupancy dropped below our standard floor, and interest coverage fell cleanly short of where safety begins. When multiple structural metrics deteriorate at the same moment, the income figure alone stops telling you the full truth. Who this is for depends on where you are in your investing life. If you are in your 50s and still adding to your portfolio, an occupancy wobble in one segment might just be a name worth watching for a better entry. But if you are in your 60s and drawing down income today, a distribution cut on a name you hold deserves a straight answer, not a headline. What actually happened this quarter starts with the results themselves. MIT reported its first quarter results for financial year 26-27, with distribution per unit of 3.11 Singapore cents, down from 3.27 cents a year earlier. That is a 4.9% decline across a single period. On its own, that would not normally be alarming. What sits underneath it is why we're here. Quick orientation on what MIT actually is for anyone newer to this trust. It holds a major footprint across data centers, high-tech business parks, and flattered factories. The Singapore industrial base has been the historical foundation, while the North American data center portfolio has been the headline growth story for years. This quarter is the first time that specific growth engine showed up as a genuine drag rather than a tailwind. What did not happen this quarter is worth being precise about. The Singapore-based industrial and business park assets are holding up reasonably well without signs of widespread distress. The pressure is concentrated, not diffuse. This is not a REIT where every asset class is deteriorating at once. The data center problem is the one driving everything else. Portfolio-wide occupancy slipped to 90.7%, already below our 95% standard for prime assets. But the data center segment specifically sits at 85%, and within that, the North American data center portfolio alone has fallen to 82.5%. That is the clear driver of the portfolio-wide miss. Data center exposure is not one thing, and this divergence proves it. Where these centers sit, who occupies them, and how the lease terms are structured all matter more than the segment label alone. The North American softening shows that the label alone can't protect you from vacancies. Gearing moved the wrong way too. Aggregate leverage rose from 34% in March to 37.5% this quarter. That is a breach of our 35% ceiling by 2.5 percentage points, and it happened in a single quarter, not a slow drift over several periods. Coverage is a clean gate failure here, not a close call. Interest coverage ratio, calculated on trailing 12-month operating income against gross interest expense, comes in at approximately 3.78 times. That sits meaningfully below our 4 times floor. The trust's own headline disclosure had suggested a figure right at 4 times, but the underlying quarterly data resolves that ambiguity. This is a genuine miss, not a boundary case. When 3 gates fail at once, that's not a coincidence. Gearing, occupancy, and coverage don't usually move together unless something structural is happening underneath all 3. In MIT's case, the North American data center portfolio is losing tenants faster than the trust can backfill or refinance around it. One core problem showing up in 3 places. The financial health checklist lays out the full scorecard. Gearing failed at 37.5%. Occupancy failed at 90.7%. Interest coverage failed at approximately 3.78 times. Net debt to EBITDA sits at approximately 5.98 times, a yellow flag. The trailing yield of 6.57% clears our 4.7% floor comfortably, which tells you this is a balance sheet story, not a payout story. Legacy holders versus fresh capital is where this splits into 2 different conversations. If you already hold MIT, your yield on cost is likely still attractive, and this quarter's dip does not erase that. If you're considering fresh capital, you'd be buying in at $1.91 into a trust currently sitting on 3 failed Hardgates with no discount currently on offer for taking on that risk. These are genuinely different questions and potentially different answers. An existing holder is asking whether to stay, and a 1-quarter dip is a reason to watch more closely, not necessarily a reason to exit. Someone considering fresh capital is asking whether to enter, and entering today means accepting 3 failed gates at today's price. The dividend trajectory shows exactly how we got here. The payout moved from 3.27 cents to 3.11 cents, a single period decline of 4.9%. Under this framework, that's a warning signal, not yet an established multi-period trend. The next quarter's print will tell us whether this was a single rough patch or the start of something longer. You don't need the jargon to get the edge on a piece like this one. Not everyone wants to read balance sheets and results decks for fun. Sometimes you just want to know what's actually happening with your money, explained plainly, before everyone else catches up. That's the whole idea behind Iggy's Elite Investors. What members get is straightforward. Elite investors receive the full forensic breakdown with 0-day access the moment the research is ready, not a week later when it's already old news. That includes the complete watch list, the practical cheat sheets, and every walkthrough for 12 Singapore dollars a month. Back to Mapletree Industrial Trust. What this is really worth depends on which model you trust. Investing Pro's fair value model puts MIT at $2.72, 42.2% upside from here. 15 analysts, on average, put the target closer to $2 flat, under 5% upside. That's a 36% spread between two legitimate approaches to the same trust. How you read that valuation gap matters more than picking a side. Neither figure is wrong. A model assuming occupancy recovers within a year or two will move quickly toward a higher number. Analysts pricing in more uncertainty about the timeline will sit closer to where the stock trades today. Watching that gap narrow or widen over the next couple of quarters will tell you more than either number does in isolation. A wide valuation spread is itself a signal. When two credible sources land 36% apart on the same stock, that gap is telling you the market hasn't settled on whether this weakness is temporary or structural. Until MIT's next print narrows that gap, that uncertainty is exactly what a trust sitting on 3 failed Hardgates should carry. Where this leaves MIT is Zone 4. Caution, this is a fundamentally sound trust with an established income-producing portfolio. The constraint is a compound one, occupancy weakness in the North American data center book flowing directly into gearing and coverage pressure. Not one isolated mechanic, but 3 gates failing together. This is not a permanent verdict. It reflects the balance sheet as it stands this quarter, not a final judgment on the business. A reader with a genuinely longer runway before drawing down retirement income has more room to ride out a correction like this one. Capital sitting beyond what you actually need for retirement drawdown can reasonably be held to a different standard, since the consequence of being wrong isn't the same in both cases. Why 4? And not plain 4 comes down to how many gates actually failed. Gearing missed by 2.5 percentage points, occupancy missed by 4.3 percentage points, and either one alone, paired with a second failing gate, is enough to trigger the wider suffix. Coverage adds a third independent failure, and net debt to EBITDA sits clearly above our yellow flag line as well. This is not a single metric story with 2 supporting technicalities. What to watch next is straightforward. If North American data center occupancy stabilizes, if gearing eases back under 35%, and if coverage climbs meaningfully clear of 4 times, this is a name that could reasonably move back towards Zone 3 or better. Until that happens, 3 failed hard gates in 1 quarter is not something this framework treats as a technicality. I am Iggy, forensic investor and your guide through the SGX market jungle. If you want the full breakdown ahead of the free version, Iggy's Elite Investors get 0-day access, link in the description. Get everything, 0-day access on both platforms, full red zone watch list, institutional grade cheat sheets with Iggy's Elite Investors, $12 a month. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.